Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey there, welcome to episode 55 of the Financial Purpose Podcast. We're going to talk today about some real estate stuff, particularly around 1031 exchanges. And the reason I pulled this topic is we were camping for the holiday weekend. You know, I was out there for a few days, and we had just a variety of friends come in. And in two separate conversations over the weekend, somebody asked me about how to deal with either an investment property if they were going to sell it, or why I think that the housing market is so weird and has been weird since 2008. And then, of course, you know, the whole thing about 1031s, or how to sell the investment property, or how to trade it, or how the taxes worked. And every time I have a conversation with somebody about any of this, I find that there's always like a mix of information. It's like part of it's partly right, and some of the tax stuff is kind of close, and there's just a lot of information that people kind of know, but a lot that they kind of don't know, or they've heard random things mixed up, or even worse, somebody on TikTok had some really good advice on how to like put this in an LLC and then sell it to this one and then move it over here, and you know, this whole shell game stuff that people tend to think they're really smart on, and they've got the information about half correct. So I thought I would just dedicate this episode to just kind of like a 101 version of 1031 exchanges for real estate investors. I have a lot of clients who have real estate properties, investment properties, and things like that. So this is a more common topic, and we ought to talk about it. So this is going to be straightforward, not difficult to understand. I'm not going to talk about numbers. There's no charts or anything like that. There is a complimentary blog post for 1031 Exchanges 101 on lifemoveswealth.com. Head over to the blog section, and you'll find this pretty much exactly the same, except the nice thing about the podcast is I get to riff a little bit, and so you'll get a little bit of a different flavor. But if you want to read what I'm working through, lifemoveswealth.com/blog, and the most recent post as of the time of recording this episode is going to be the 1031 Exchanges 101 version. So here we go. If you're a real estate investor, you probably have heard of 1031 exchanges, and it sounds complicated. Why is it a number? What is the deal? In reality, it's a great tool to help grow your real estate investment portfolio. You get to defer taxes, and it's a great way to keep kind of building wealth and hold on to more of your own money rather than surrendering more of it to the government by the way of capital gains and things like that. So I hear, as I said, a lot of confusion, jumbled up details when it comes to how a 1031 exchange works, how the taxes are impacted, how the reinvestment money can be used, how it can't be used. So let's go through a simple breakdown of how 1031s work and even what they are. So a 1031 exchange gets its name from Section 1031 of the IRS tax code. It allows investors to sell investment property and reinvest the proceeds into what's called like-kind property, and you get to do that, and that's not a taxable event. You're able to defer the capital gains taxes on the sale of the original property. So it's a great way to kind of swap properties, but there are some important rules that you need to follow if you're going to consider a 1031 exchange or one of the alternatives that we'll also talk about a little bit later in this episode. So here's kind of the basics of how it works. So the first thing, I mentioned the term like-kind property. Basically what that means is that the property that you sell, so let's say you have an investment property, be it investment, a home or a duplex, or maybe it's a building that you use for a business, or a business rents that building from you, whatever it is, you're going to sell that property and you're going to buy something that's similar in nature. So if you're selling a investment living property where somebody lives, right? A rental house, a duplex, multifamily, something like that. You're going to exchange it for another rental home, duplex, multifamily property, that kind of thing, or a building for a building, something like that. It has to be similar. You cannot use it for your personal or primary residence. That part does not work. And that was one of the questions. It was like, well, can I kind of say that it's, this other, investment property, and can I then build on it, and can I, and those things get really, really wonky when it comes to following the tax code. And there can certainly be issues if you try to kind of skirt around the rules. So it really does need to be like kind for like kind. Only on investment properties, cannot be on your personal property or your personal use, primary residence, or anything like that. The other thing you need to know is that there are very specific time constraints when you're doing a 1031 exchange. And here's the way the time constraints work. Once you sell the property that you currently own, you have a total of 180 days to identify and close on the next property. Now, inside of that 180 days, the very first 45 days, you have that number of days to find or identify any property, a number of properties, or a single property that you intend to then purchase. And then you have the rest of the 180 days to close on one of those properties that you've identified. So it's very important. It's not 45 days plus 180 days. It's 180 days total from the date of the sale of your original property, the first 45 of which you have time to scout and to search and locate the property. People who can help you do that, if you're not able to do that on your own, or if you're really concerned about the time frame, is what's called a qualified intermediary. There are lots of them all over the place. There's many here in the Valley. And what they do is they're a third party. They must handle the 1031 exchange to make sure that it's done properly and to keep it tax deferred. And the reason why is because you can't touch the money. So you sell the property, you can't take the money, put it in your bank account, and then go buy another property. That doesn't work for the 1031 exchange, because in the eyes of the IRS, you received that money, you're going to pay capital gains tax on it. Possibly you're going to have some recapture of any money that you were able to depreciate from the property over time. And the IRS is going to say, yeah, you owe tax on that money because you received it and it went into your bank account. And you're going to say, no, I took it and I bought another property. And the IRS is going to say, you did it wrong. So a third-party intermediary who's qualified to do a 1031 exchange is who you're going to work with. So you can't touch the money from the sale. They can handle the transaction. They receive the money. That keeps it from being taxable to you. And then they're able to help you identify properties. They're able to deploy quickly on the purchase of another property. And again, just make sure that you don't touch any of the cash. If you do, it's considered, the term is boot. That in any of the amount of money that you take is considered boot. And so that's kind of like from the old saying, to boot, which means like you got something extra or something that wasn't currently included. That's what any money that you actually touch is considered, and that money is taxable. So just make sure you don't touch profits, you don't touch any of the money. Have it go directly to the third-party qualified intermediary. Have them do the exchange. Now, of course, the biggest benefits of the 1031 exchange is absolutely the tax deferral, especially if you've been holding on to this property for quite some time. You're going to have to do just like you would if you're selling any other investment. You're going to have to factor your cost basis. So what did you pay for it? In the event that it's a piece of real estate, not only what did you pay for it, but what cost did you put into it for improvements? And if it's a house or a building, it's going to be things like, did you replace windows? And did you have to replace, heating and air conditioning units? Did you put on a new roof? Did you have to install new flooring? Like all those kinds of things that are like structural in nature. Things like, I bought a stove. Well, that's not really, I mean, you could talk to your accountant about that, but that's not really an improvement. That's kind of like an appliance, and that's subjective. But things that are actually needed to make the property usable, those are going to be considered investments that increase your cost basis. And then when you sell the property, you're going to take your sales price, you're going to subtract your cost basis, and the amount of money that's left over, that's your profit. That's the amount of money that's taxable. And so having the ability to defer those taxes pretty much indefinitely, because you can continue to 1031 exchange forever. And that really can be very, very helpful. Or you can be strategic with when you would actually sell the property and receive profits based on other things that are happening in your income and your tax situation. So over time, the great thing about that is it can really increase your overall returns over the life of the real estate investment, not just that one property, but the original one, and then the one that you've exchanged, and then possibly even going forward, because you can continue to exchange into bigger and better things. And so now that's all 1031s. There are a couple of alternatives if you're tired of kind of managing this directly. A 1031 exchange may not be the right choice for every investor, so there are some other alternatives. The first one, and this is probably the more common, is what's called an opportunity zone investment. There, again, you get the capital gain deferment. It's not considered a taxable event if you sell the property and the proceeds go directly into the opportunity zone fund. Now, the caveat here is naturally that money can go into your bank account and then into the fund, because you're going to have somewhere to store the money until you invest in the opportunity zone fund. But you have a certain number of days. It's still within that time period, the 180 days from the date of the sale, to get the money from the closing into the opportunity zone fund. You can hold the investment. Initially, the time frame that you're supposed to hold them is 10 years. There's some tax advantages for holding them through that period of time. Every one of those funds works just a little bit differently, and they invest in different properties all over the country. And they're really interesting vehicles. They're managed fairly well. There's some government oversight. Some of them are managed incredibly well. I have a couple of clients who are holding opportunity zone investments because they sold an investment property and wanted to defer the capital gains. A lot of the tax benefits are kind of winding down. They were the best between, say, 2019 and 2020, the end of 2025. That was like the optimum time to buy an opportunity zone fund. And there's still some good options, but some of the tax benefits were best if you had bought in a couple of years ago. But anyway, what an opportunity zone fund does is it's a privately held investment. They're going to go into areas that are underserved. They're going to spur economic development. So they're going to build apartment complexes and office buildings and things like that. They're going to do some really nice retail and multi-living space in those areas, and you have the opportunity to invest in the fund through the planning, construction, and then you're able to, as part of your return, based on the rents that they receive and the amount of money that they're able to recapitalize, it can be a great investment. It can generate really nice returns, and again, you get the tax benefit of deferring the capital gains from the sale of your original property. So that's opportunity zone funds. The second alternative is what's called an installment sale, which is where it allows you to sell the property to the buyer and receive payments over time. And what that does is that spreads out your capital gains tax burden over a number of years, depending on how you write that sales agreement. The other cool thing is that it provides kind of like an ongoing cash flow over that period of time. So you're able to effectively sell the business, remove yourself from operation, or sell the investment property, remove yourself from the day-to-day management, and have that person buy you out over a period of time. So again, it's a great way to get a little bit of an income on an ongoing basis in a different way. And again, you're also able to just kind of chunk the capital gains, because you're only going to pay capital gains based on the payments that you receive in that given year. Another option is what's called a deferred sales trust. It allows you to basically sell the asset, the building, the business, the investment property, whatever it is. You sell it to a trust, and then the trust essentially reinvests the money, and then that allows you to defer capital gains until you withdraw from that trust. And so that gives you a little bit more flexibility, again, with when you receive the income, your tax exposure. And then effectively what happens is the buyer buys the property from the trust. So that's an interesting strategy. You definitely want to work with a professional who understands those, because it's a very, very easy, again, just like a 1031, if you have somebody who doesn't really know that process well, it's very easy for that to get completely messed up. It's easy for if the trust doesn't have real clear transparency into how it's operating, what it's investing in, how the money is flowing, what the returns are, that kind of thing. That can get really muddy as well. That can mess a lot of people up. It can the timing of when taxes are realized in the investments and when payments come out. Again, you have to have somebody who really knows what they're doing just to make sure that's done correctly, because you don't want to end up on the wrong side of a tax bill, and you also don't want to end up finding out that whatever returns you were supposed to get aren't there, and then all of a sudden the value of the asset you sold gets reduced and reduced and reduced and reduced because of investment losses. So you just want to be sure that you have really good oversight and management. Now, I should use that word very carefully. I shouldn't say management, because it's an irrevocable trust, so you cannot control it, but you still have the ability to have some oversight into what's happening there. And so you just need to have somebody who's able to know the process, know what they're doing, know how to reinvest, and keep you updated on exactly what's happening with that asset. The fourth alternative, and this is the last one, is you can invest in a REIT, which stands for Real Estate Investment Trust. If you no longer want to manage properties, you don't want to be involved in any operation, you don't want to have to deal with any of the oversight, you basically can reinvest your money into the REIT. And what they do is, that's usually, again, a private equity fund. They're investing in all sorts of things, multi-family homes, could be multi-property mixed use. It can be storage units. It can be malls. It can be all sorts of things that they're investing in. Hospitals, there are REITs for those, and all sorts of facilities. And so because there's a lot of options, you want to be sure that you have somebody who knows the real estate investment trust market and can help you decipher which ones have the best promise for how that REIT is invested for returns going forward. So a good example is, when I say promise for returns, you want to be sure that you're not investing in a REIT that doesn't really have a future for those properties, or doesn't have a good future. So, for example, over the past maybe 15 years, mall REITs have been kind of tricky, because people really, for a period of time, weren't going to the mall, and so we were seeing a lot of them close. We were seeing some of them get kind of repurposed, and that was the trick. So now what's interesting about mall REITs is they're able to buy the mall properties and completely reinvigorate those things. And we have a couple that are happening here in the Valley. Wherever you're listening, you probably know of a couple as well. And they basically redesign these things. Sometimes they completely level them and build multi-use properties. I mean, we have one going up here in the Valley where it's like half of the entire bottom floor is a Whole Foods, and then there are 7, 8, 9 stories above that where you have condos for sale. And so there's a lot of that happening with mall redevelopment, but now people are actually starting to go back into some of those mall properties, and depending on what's in the mall and the owners who own that property are doing a really good job kind of repurposing even the flow of traffic and the anchor stores and what's there, what the attractions are at the mall, and they're bringing in different things. And so you can do that as an example. Now, the difference here is that when you invest in a REIT, you do have to pay capital gains tax on the sale of your original property, but you're reinvesting into something that's real estate. You don't get the tax deferment, but you do get the benefit of investing in real estate. It's totally hands-off approach, and it can add a little bit of still that kind of real estate diversification to your wealth. Okay, so all of that, hope I didn't go through that too fast. The primary question that I often get with anything that's involving a 1031 exchange, and I talked about earlier where if you take any of the money, it's considered boot or extra. And so that's the question. What happens if I just decide to keep the cash and I don't want to mess with any of it and I just want to do something totally different? Okay, if you decide to sell the property, keep the proceeds instead of reinvesting through a 1031 exchange or one of the other tax-deferred options, you'll be required to pay capital gains tax on the profit from the sale. And again, remember, the profit is what you sell the property for minus your cost basis. And a good CPA is going to be able to help you maximize the cost basis to manage the amount of profit that you're going to receive. Now, again, we don't always want to drive profit all the way down because then it looks like you didn't get a good investment return. But we do want to make sure that we manage the tax liability because that's going to have impacts in other places in your financial life. So it's important that we have a really good, solid understanding of your cost basis and that we maximize both the amount that you're able to get for the property and the amount of profit that you take. So you're going to pay capital gains tax on that. How much you owe is going to depend on how long you've owned the property. If you've owned it for more than 1 year, then you'll likely be subject to long-term capital gains rates, which are going to range from 0 to 20%. And where you fall on that's going to be 0, 15, or 20, and it's going to depend on your income bracket. And it's going to be your adjusted gross income is how that's going to be determined. So additionally, I mentioned this earlier, you may owe depreciation recapture taxes, which is it applies to the portion of the property that's been depreciated for tax purposes over the amount of time that you've owned it. And most likely, if you're working with a good CPA and you have an asset, that asset's going to be on a depreciation schedule. There's some tax benefits for that. So you might have to recapture or re-include some of that depreciation back into your cost basis. And so there's going to be that. Again, your CPA is going to help you understand exactly how that applies to the property that you've sold. And, the thing to consider is that while selling the property and taking the cash gives you the cash in your hands that you can do whatever else you want with, it just can potentially be a significant tax bill. And before making that decision, you're going to want to weigh all the benefits and the pros and the cons for keeping the cash versus doing a reinvestment that allows you to defer the gains. So is a 1031 exchange right for you or any of the options? They can be a great strategy. If you're focused on growing your real estate investment portfolio, you want to avoid a hefty tax bill when you're selling properties. It can be a game changer, and it allows you to grow your wealth faster simply because you're deferring the taxes. The best way, I always tell clients, there's really two ways to completely destroy any financial plan. The first way is taxes that are properly planned for, and the second way is a health event that we have no insight into, and you often don't know what your health is going to be. But if we don't prepare for those two things, it can really eat away a lot of your net worth and your wealth very, very quickly. So if a 1031 exchange doesn't seem right for you, definitely check out the alternatives. And you're going to want to make sure that whichever you choose has the best alignment with your financial goals. So basically, just like with any other tax-related strategy or any other financial planning or investment strategy, it's important to know the rules. You want to make sure that you're following them well, so that way you're playing the right game and you're not, in the penalty box or in the tax penalty box, is a better way to say that. And it's helpful to get the right advice to ensure that you have a smooth transition and transaction any which way that you decide to go. So if you have questions about how a 1031 exchange works, if you have a investment property and you're curious about what that might look like for you, talk to a tax professional, talk to a financial advisor. By all means, you can send an info to me at info@lifemoveswealth.com. Happy to review the situation, talk through your options, get an idea of what's going to be best for you. Bring in your tax professional to make sure that you have a team of professionals who are looking at the situation to make sure that all the bases are covered. And I'd love to help you with that. So would love to hear your thoughts. If you've completed a 1031 exchange, if you're thinking about a 1031 exchange, if any of this was just unclear, drop a comment, send an email again, info@lifemoveswealth.com. Happy to help, to talk, and to get you pointed in the right direction. So I hope that was helpful on 1031s. Again, there's a partner blog post at lifemoveswealth.com/blog. And I think that's what I got. I don't want to beat the dead horse. So until next time, go be financially awesome. Take care. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.